Physical silver trading on the Shanghai exchanges has been consistently commanding prices above COMEX silver by a margin that simply should not exist in any properly functioning global market. This is not a minor regional anomaly or temporary disruption caused by shipping delays. This premium has been persistent, it has been expanding, and it is communicating something that the paper markets either cannot acknowledge or are choosing to ignore. Let me state this directly. When one of the largest physical commodity exchanges on the planet is pricing silver meaningfully higher than the world's dominant futures exchange, you cannot dismiss that as background noise. You cannot explain it away with casual references to currency adjustments or logistical friction. Something structural is occurring beneath the surface of this market. And the question that should be occupying every serious silver analyst right now is straightforward. What happens when the physical market completely stops taking its pricing signals from the paper market? Because that is the trajectory we are on. And a significant number of market participants are going to be caught entirely unprepared when it fully materializes. So today, we're going to examine precisely what is unfolding between Shanghai and COMEX, why this premium continues to persist, what it reveals about actual physical supply conditions, and what it means for the silver market going forward. No exaggeration, no promises, just the mechanics of what is happening directly in front of us. To understand why this Shanghai COMEX divergence carries the weight it does, you first need to grasp that these are fundamentally different types of markets accomplishing fundamentally different objectives. COMEX, the commodity exchange operating under CME Group in New York, functions as the dominant global benchmark for silver pricing. When you observe a silver price quoted on financial media, that figure almost always reflects the COMEX futures price. It is where the overwhelming majority of silver trading volume is concentrated. Trillions of dollars in notional silver value move through COMEX annually. But here's what most observers never seriously consider. The vast majority of that volume represents paper trading, contracts for future delivery that statistically almost never result in actual physical silver transferring ownership. The rate at which physical delivery actually occurs on COMEX represents a fraction of total open interest. Most contracts are rolled forward, settled in cash, or offset before they reach maturity. This is not concealed information. It is simply how futures markets function, and under ordinary circumstances, the distinction matters little. The futures price is supposed to track the real-world price because arbitrage maintains alignment. When futures drift too far from physical reality, participants step in, purchase the cheaper instrument, sell the more expensive one, and the gap closes. That is the theoretical framework. That is how it works in textbooks. Now consider the Shanghai Gold Exchange and the Shanghai Futures Exchange. These are China's primary precious metals trading venues, and they operate on a fundamentally different principle. The Shanghai Gold Exchange in particular is a physical delivery exchange. The overwhelming majority of silver transacted, there results in actual delivery. Metal exits the vaults. It moves into the possession of industrial consumers, refiners, fabricators, and investors. This is the foundational distinction from which everything else in today's analysis follows. COMEX is primarily a price-setting mechanism driven by paper contracts. The Shanghai exchanges are primarily physical markets where real metal changes hands. When these two market types agree on price, it indicates that paper and physical are synchronized. Supply is meeting demand. The global system is functioning as designed. When they disagree, and when physical begins trading at a persistent premium to paper, that communicates something entirely different. It tells you that real metal in the physical world is more difficult to obtain than the paper price implies. That is precisely what has been occurring. The Shanghai premium describes the difference between the price of silver on the Shanghai exchanges, converted to US dollars per troy ounce for comparison purposes, and the corresponding COMEX spot, or futures price. Under normal, well-supplied market conditions, this premium is modest, a few percentage points at most, readily explained by shipping expenses, import duties, value-added tax considerations, and the ordinary friction involved in moving physical metal across the Pacific. What market participants have been observing in 2026 does not fit that description. The premium has at points been substantial. Analysis from multiple market researchers and widely referenced data providers has documented this premium reaching into double-digit percentage territory on multiple occasions. At certain intervals, Shanghai silver has traded at levels implying a per-ounce premium of $10, $15, or $20 above what COMEX was quoting simultaneously. Rather than anchor this discussion to specific prices that will have shifted by the time you watch this, the focus should remain on the structural reality. The precise figures move from session to session. What matters is the persistent and abnormal magnitude of the spread. The direction and scale of this divergence have been extensively documented and are not subject to serious dispute. For historical context, consider that through most of the modern silver market's history, the Shanghai COMEX spread remained relatively contained, a few percentage points in either direction. When premiums expand to 10, 14% or beyond and remain there, you are observing something the market has encountered very rarely. Consider what this means for a practical participant. If you are a Chinese manufacturer requiring silver for solar panels, consumer electronics, electrical contacts, or medical equipment, you are paying a price dramatically exceeding what the London or New York benchmark quotes. And you are paying it willingly, consistently, month after month. Why would any rational buyer voluntarily absorb that kind of premium unless doing so was the only alternative to not obtaining the metal at all? That question is central to everything this analysis addresses. Periodic attempts have been made to attribute this premium to other factors. When currency fluctuations, tariff adjustments, regulatory modifications affecting Chinese imports, these elements each contribute something at the margins, but none of them individually or collectively comes close to accounting for the magnitude and duration of the premium being observed. When the extraneous factors are removed from the analysis, one explanation consistently fits the available evidence. Physical silver supply flowing into China is not keeping pace with physical silver demand, and the premium represents the market's mechanism for communicating that reality to anyone paying attention. The mechanics of why physical silver is leading price discovery deserve careful examination, because this is where the analysis becomes genuinely significant and genuinely uncomfortable for those who maintain that futures markets invariably establish the accurate price. For decades, the standard model of precious metals pricing operated as follows. The futures markets, primarily COMEX and the London Bullion Market Association, established the benchmark. Physical markets globally then transact at modest premiums or discounts to that benchmark reflecting local conditions. Paper leads, physical follows. What Shanghai is demonstrating is that this model may be experiencing a fundamental breakdown. Consider the flow of physical silver into China over the preceding years. Silver imports have been running at record or near record levels, drawing from London vaults, Australian mining operations, South American refiners, and every accessible source. The LBMA has publicly disclosed declining silver inventory in London storage facilities. That metal traveled somewhere. A substantial portion traveled east. The critical observation is this. Despite those substantial inflows, the premium persists. If supply were genuinely meeting demand, the premium would compress. That is elementary economics. When a market is flooded with additional supply, the price differential narrows. Instead, the premium has remained elevated or expanded, which can only indicate one thing. Demand is absorbing arriving supply as quickly as it appears and then beyond. This positions the physical market in the role of price leader. Shanghai is not waiting for COMEX to communicate silver's value. Shanghai is bidding for real metal based on real, on-the-ground demand conditions, and the paper market is struggling to reflect that reality. The arbitrage argument deserves direct engagement because it will inevitably be raised. If Shanghai is paying more, traders should purchase COMEX silver at lower prices, ship it to Shanghai, capture the spread, and close the gap. In theoretical terms, this is accurate. In practice, meaningful constraints operate. First, the silver must exist in deliverable form in COMEX-approved vaults. As we will address shortly, those inventories have been contracting. Second, converting COMEX warehouse receipts into refined, deliverable bars meeting Shanghai Gold Exchange specifications requires time. Third, export controls, shipping timelines, and insurance costs introduce friction and delay. When demand is urgent, and industrial silver demand in China right now is urgent, waiting weeks for arbitrage to gradually compress the premium is not a viable option. You pay the premium or your production line stops. That is the concrete reality confronting Chinese manufacturers, and it is the primary reason the physical market is currently setting terms. This brings the analysis to one of the most closely monitored data points in the silver market: COMEX vault inventories. COMEX reports two categories of silver in its approved storage facilities. Registered silver describes metal that has been assigned to a specific contract holder and earmarked for delivery. Eligible silver describes metal sitting in the vaults, meeting COMEX specifications, but not currently assigned to a contract. Think of registered as committed, eligible as present, but uncommitted. Both categories have faced significant pressure. Registered inventories in particular have experienced sharp drawdowns. Data from CME Group's own published reports, along with analysis from market researchers who track these figures systematically, has documented the persistent contraction in COMEX registered silver stocks through the past year and into 2026. An important distinction applies here. The fact that eligible silver sits in a vault does not mean it is accessible for delivery. Eligible silver belongs to specific owners. It may be held by an exchange-traded fund. It may belong to a private investor or institution with no intention of selling. The eligible category does not function as a reserve available for general use. It represents other parties' metal that happens to be stored in a COMEX-approved facility. When someone states that ample total silver remains in COMEX vaults, understand that the registered category, the metal actually available to fulfill delivery obligations, has been declining. And the ratio of open interest to registered silver has been increasing, meaning more paper claims are competing for fewer ounces of deliverable metal. This is not a fringe observation. CME Group publishes this data daily. Any market participant can download the reports and track the trend independently. To genuinely understand why the Shanghai premium shows no signs of resolving, you need to appreciate the scale of what China is currently doing with silver. China is the world's largest producer of solar photovoltaic cells by an enormous margin, accounting for approximately 80% or more of global solar cell manufacturing. Every one of those cells requires silver paste, a conductive material forming the electrical contacts on the solar cell. Silver is not optional in this manufacturing process. No commercially viable substitute exists at industrial scale. Copper, aluminum, and other conductors have been evaluated, and none replicate silver's electrical conductivity and corrosion resistance in this specific application. The global transition towards solar energy, accelerated by government mandates, corporate sustainability commitments, and the straightforward economics of solar, having become the least expensive form of new electricity generation across most of the world, has driven solar silver demand sharply higher. The Silver Institute has estimated that solar photovoltaic applications have consumed well in excess of 200 million ounces annually in recent years, with continued growth projected. Some analysts forecast demand approaching 250 million ounces or beyond within the next several years, and that represents only one application. Silver is essential in fifth-generation telecommunications infrastructure, in electric vehicle electronics, in defense and aerospace applications, in the rapidly expanding data center construction driven by artificial intelligence development. Every server, every network switch, every relay depends on silver contacts. Every advanced semiconductor package incorporates silver or silver alloys. China sits at the center of virtually all of these supply chains simultaneously. When Chinese authorities commit to expanding domestic semiconductor capacity, that requires silver. When Chinese electric vehicle manufacturers accelerate production, and they are accelerating substantially, that requires silver. When fifth-generation base stations deploy across the country, that requires silver. This is not speculative or sentiment-driven demand that might evaporate if market conditions shift. This is embedded industrial demand from manufacturing processes that are already operational, already contracted, already committed. Production facilities require this metal to function. Without it, production halts, contracts are breached, and revenue is lost. That fundamental reality explains why the Shanghai premium persists. For a Chinese solar manufacturer, absorbing an additional 10 or 15% cost for silver is a minor consideration compared to the consequences of halting a production line. Meanwhile, withdrawal data from the Shanghai Gold Exchange has been remarkable. The exchange publishes the volume of physical silver withdrawn from its vaults weekly, and those figures have been running at or near record levels. This metal is not accumulating in storage. It is being extracted and consumed by industry at a pace that is genuinely difficult for the supply side to match. The industrial pressure on silver supply extends well beyond China. India has been aggressively developing its own solar manufacturing capacity, supported by government incentives and import tariffs on Chinese panels. Indian silver imports have surged in recent years, representing another substantial draw on the global physical supply pipeline. The United States, through the Inflation Reduction Act and subsequent policy measures, has been subsidizing domestic solar and clean energy manufacturing. New solar panel facilities, battery plants, and semiconductor fabrication centers are all under construction on American soil, and all require silver. Europe's energy security priorities following geopolitical disruption have dramatically accelerated solar deployment across the continent. Germany, Spain, Italy, and France are all installing solar capacity at unprecedented rates. Each gigawatt of installed solar capacity requires a meaningful quantity of silver. Here is where the supply-demand arithmetic becomes genuinely constraining. Total global silver mine production has been essentially flat. The Silver Institute's World Silver Survey has documented mine output hovering near 820 to 830 million ounces annually in recent years. No significant new silver mine has been brought into operation that materially alters the global supply picture. Silver mining is predominantly a byproduct activity. Approximately 70 to 75% of silver mine supply arrives as a secondary output of gold, copper, lead, and zinc extraction. Primary silver mines are relatively rare globally. This means silver supply does not respond quickly to price incentives the way other commodities might. Deciding to produce more silver requires finding and developing new copper or gold deposits that happen to contain silver, or investing years and billions into the uncommon primary silver deposit. The supply response is slow, capital-intensive, and structurally constrained. Silver recycling, the other primary supply source,